Alright, again, hello, my dear friends. Welcome back to Trading by the Book without any kind of luck. Today we're going to be talking about critical understanding, the lagging and leading indicators, how to tell them apart, and essentially what should we maybe give ourselves a little bit of time to explore. The channel that you and I are going to be able to talk about more details, more complicated, maybe as viewpoints, right? So settings, one-on-one. So if you guys do want to talk about the Goji candles or certain patterns and the probabilities, everything, this is something that's open. You can go through our Telegram channel and we will be able to talk about this one-on-one. So, make sure to hit me up with any kind of comments, any kind of questions, things like that. So, obviously, hitting that subscribe button is super appreciative. Something that helps us understand. Leaving a comment helps us understand, me and my team, what you guys want to know, what kind of things you want to talk about, discuss. So today, let's kind of switch over to our beloved pocket option. And, let's talk a little bit about leading and lagging indicators. Overall, what is an indicator? Right, an indicator, it's a mathematical formula that gives you an idea of what kind of pattern it was running the quotes and what the quotes are doing now in comparison to what they did in the past. Right, so any kind of indicator, right? I have parabolic often selected, but essentially, when people ask me, Alex, what is the best indicator? Um, it's not really something like, hey, this one's good, everything else is, crappy. It's not a needle in the haystack. It's just something that uh, it's very subjective, right? It's about your approach, right? Actually, taking into, for example, parabolic SAR, it is actually a lagging indicator. It shows you it presents a signal when the candle closes. All right, so it doesn't really show it, right? The signal doesn't come ahead of time. It comes when the candle closes. That's essentially the definition of a lagging indicator. And we do have, on our chat, by the way, chats are live. I am keeping an eye on them and I'll answer any questions on about this. Hey, we got Gary on YouTube. Hey, buddy, thanks for being with me. We got Donald on the on Twitch. Once again, thank you guys for being with us, spending a little time with us. Now, let's take a look. All right, so as I was saying, right, guys, so that lagging indicator, it's something that gives you a signal when the candle closes. And it's very important to understand leading indicators, right? Maybe something like a rune. It actually tells you where the market might be going, right, based on the previous data. But it's very actually important, once again, to understand that indicators cannot predict the future. Right? This is something that's very, very important for you to understand that there is no such thing as a situation where three, four, five indicators will give you 100% success rate, right? So we can put a whole bunch of indicators like fractal, chaos bands, parabolic, right? We got some moving averages, right? We can put I don't know, the shaft, we can CCI. I mean, what else we got? We got accelerator, oscillator. It never really means that, hey, if all of them align about giving you a signal, right, that maybe it's going to happen like out of all of these indicators, if all of them align and give you a signal that there's going to be a particular probability of an action, it's still never a 100%. Right? It's a higher probability. Chances are that it should win if like you got like what we got three here, four, five, six, seven, eight, nine. If nine indicators give you all a signal at the same time, once again, probability is the highest that it's going to win, but it's never 100%. That's something that's very important to understand. Because, most people, once again, if you guys get an opportunity, right, if, hypothetically speaking, if I give you, right, let's say that once a month I'll give you that one trade that has, right, hypothetically has 100% probability for success, you're not gonna trade any other days, right? But I can't give you 100%. But what if I gave you two at 90%? What if I gave you five at 85% success rate? Right? So these are the probabilities. This is actually something that the reason why I'm wearing this mask is that I'm going to clarify all of these things to you where that, most platforms might dance around this issue, or most gurus will dance around the issue. Trading, it's about raising the probability of success. It's never going to be 100%. But you are able to raise the probability of success by applying certain technical analysis. So today, we're going to be talking about two crucial concepts, is that there is a leading and a lagging indicator. Now, what we want to kind of understand is that leading and lagging indicators, they're, essentially the easiest way to spot them is the ones that are superimposed on the graph. Right, so for example, anything that's over here, that's essentially a lagging indicator, right? It kind of gives you a signal after the candle closes, right? We got, like, for example, moving average, or that's set up, in my opinion, in my case here, it's 10, 20, and 10, 20, and 50, right? This one, this one is 50. There we go. Yeah, that's the purple one. And this one, yeah, it's a 10. That's a green one. So I got a 10, 20, and 50 period. A little bit longer, right? With the 1 minute candle, it's a little bit longer or more inclusive period than alligator, for example, right? We got alligator, but alligator's got a little bit less periods, right? So where I have 10, 20, and 50, it's got 5, it's got 8, and it's got 13. Right, so this, this kind of setting means that it's very fast reacting to what the market is doing. But essentially, once again, it does need to close the candle before showing you a signal. And this is something that usually works very good in volatile market conditions when the asset goes up and down in waves. Big candles, kind of like, what do we got here? We got Euro Dollar OTC. We got big candles, kind of happening. We actually, have different indicators like ATR that shows the volatility, right? Once it goes, there's a range here, and once it goes above this range, the candles are actually kind of big, versus when it's on the bottom, towards the bottom, the candles are kind of small. So this is something that's actually a really good indicator. If we take, I am going to talk a little bit greater detail at some point about support and resistance levels, but let me just bang it out right here very quickly. You see, when we have a relatively high volatility, we got candles going up very well, right? We got 1, 2, we got 3, 4 times that this Euro Dollar OTC touched this level. So it is an established, wonderful established level of support. And once it breaks through, well, we got a high chance that it's going to continue to break through for a while. All right, and we see that these candles are kind of big, they're nice, they're, weighty, there's big bodied candles, not like these little body candles and lots of wick. All right, these little lines at the top and the bottom, just called the wick. Right, but the idea is that once it breaks through, we got an understanding that the this momentum that was driving this asset up for a while. Actually, let's see, 0957, and it went to 0990. So essentially, that's 33, right? That's 33 pips. That's pretty cool. 33 pip movement, and it's about 300% profit in standard lot with Euro Dollar. Now, anyways. So what we understand is that, man, when is the volatility dropping, right? So if there is a movement, it's inertia, momentum to this asset going up, we do want to have an indicator maybe that tells us, when the volatility drops, the momentum lowers. And essentially, this is what happened here. Here it rose, right? And it's kind of, if we're moving this across, we understand that, we see that this, well, ATR, I kind of have them twice, that it's lowering, 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 and, kind of here, like towards the top, it petered out, the volatility, right? The amount of people buying or selling a particular asset, this is something that affects the volatility, right? So if lots of people all of a sudden immediately start buying, whoosh, the asset, there's going to be lots of volume in this, lots of, volatility. So the price will change. What is volatility? It's when the price is able to be changing or changing from, like a specific kind of movement very, very quickly, aggressively moving into a different direction or into the same direction, whatever. So the big candle means usually there's lots of interest in that particular level. So lots of people open the position, drove the asset upwards or downwards, right? So, but if, we got big candle, up, we got big candles, all of a sudden they start getting smaller and smaller, right? If they start to saw a particular level, up, down, up, down, up, down, that kind of means that in this case, bulls have lost the momentum and bears are gaining it. All right, so or essentially any indicators, they're divided into multiple groups. There's volatility, there's like for example ATR and ADX. There's momentum, there's trending indicators, there's trend reversal indicators. So all of this means though is that you get a very big flexibility about how you trade. We can trade, you and I can actually pick any kind of indicators one-on-one or specific indicators for you one-on-one to determine, right, which ones are the best for you specifically. And this is the important part, for you specifically, because you gotta understand that depending on your goals, depending on your desires, depending on your psychological, fortitude, depending on your finances, depending on your stress resistance, so to speak. All right, there's so many factors that need to be accounted for to determine your style of trading. All right. Once again, if I keep mentioning this, but for real, this is something that is available to anybody who watches my videos. You guys are able to talk to me one-on-one. I do encourage you to touch base in Telegram channel or leave a comment. I'll be hopping in and answering every single one of them personally. And because I burn with this, I burn with passion for this, right? This is something that I started doing, in greater detail, in greater depth, in 2012. But I was investing, actually, I always wanted my money to work for me instead of the other way around. Right. But anyways, so how do you determine leading and lagging indicators? Now, as I mentioned, lagging indicators do very good when the market is volatile. See, here it's trending, here it's trending, here it's kind of going sideways a little bit, but trended downward. Well, once again, with 1 minute candles, it's not really something that's so great. But trending, trending, trending. So this is this is a good thing for. God, I mean, actually, the way that, I would love to have traded during this particular movement, right? There is, we could actually spot here head and shoulders pattern, which is something that we can, also take advantage of these kind of things. Anyways, leading and lagging indicators, coming back to that. Leading indicators is the ones that tell you where the market might be, right? So when we click here, let's use the easiest one, for example, RSI. All right, so RSI is relatively easy because it says that once there is a middle level where it's kind of happy, right, and there's a range, right? There's the, essentially 70 and 30, all right, range between 70 and 30. Now, when the asset reaches a particular point on the top, if it touches or breaches, even better, if it breaches the top level, it kind of shows you that it's at that moment overbought. All right, so if the price is overbought, right, think about, I don't know, your regular, I don't know, t-shirt that you went and you bought for $5. All of a sudden you come back and you say, you see that the same t-shirt costs $10. And you're like, wow. All right, so but it's not, it doesn't cost it, right? Like you understand that it's not something that, is worth it. And at that point, other people would actually think the same and they would probably start selling it, affecting the supply and demand principles. All right, so anything in the world that we can look at, right? I don't know, this watch, right? Phone. What I had for breakfast, my haircut. As you can see, it's very stylish. The value, the price for all of these things is determined with supply and demand principles. So something that's very, once again, I might go into greater detail. I might say it again at some point. We got only two people so far with us. We got Gary and we got Donald. Thanks once again, guys, for hopping in and checking in. But the idea is that the value of anything, a price of good or service is determined by how many people want that and how much of it is available, right? The supply, how much it's available, and demand, how many people want it. Right, so if your job, whatever it is that you're doing, if you're the only specialist, that means the supply is very limited. And that means that if the demand is high, your salary is going to be through the roof if you're the only specialist that can do that. Right, so that's something that we need to keep in mind. This is actually something that is applicable to trading, why we have volatility. Right, so if something is overbought, if there is so much value placed on something insignificant, at some point people are going to be like, nah, I'm going to sell that. I'm going to get my money out. Right, I bought a shirt at $5. So, hell yeah, I'm going to sell it at 10, make some money. All right, it's all about that. That's essentially how markets move. Market moves through two emotions, greed and fear. Desire to make money and fear of losing it. All right, so let's, call things the way they are, by their true faces, by the true names. And essentially, when the asset is overbought, we understand that there might be a lowering of demand, right? So there might be, hey, I don't want to buy something that's very expensive. I think that at that point, I'm going to expect it to go down in value because people are going to want to cash out their profit. Those who bought the shirt at $5 will probably sell it at 10, all right? Unless there's certain mitigating factors. Anyways, so something that we need to keep in mind. So leading indicator tells you at some point that, hey, there should be a retracement, but it's not something that's always going to happen immediately, right? So if we look at this point right here, when it breached, went to the top, it didn't really pull back, right? It continued to go up, and it pulled back only here for a little bit. It went up again, right? So it's still kind of at this point, but we are able to see a particular downward channel. There it is, right? So it did go up. It did stay here for a while, but at some point it started to go back down. So you see with RSI, it is something that goes up and down in waves. And it kind of tells you once again, maybe towards a little bit longer run, what we're able to expect. So leading indicator is telling you where it could be in the future. Right, there's different settings, obviously, right? You could actually improve your success rate because signals may be going instead of 70-30, but going 80 and 20. And at that point, we see a range that's a little bit, wider. And when the asset reaches, the overbought, it might give you a little bit shorter term signal, right, that there's going to be a pullback. But it doesn't really, there we go. It touched here. That means that there should be a pullback. And that's exactly what it did. All right. So one sec. Okay. So there we go. There it is. Actually, that's the difference. That's the difference between leading and lagging indicators. Leading are the ones that might show you where the market will be going in the near future. Lagging is kind of showing you where it is kind of right now. And because the market changes, all right, from volatile to not volatile very quickly, that's why you would want to have both. right? So when we look over here, right, we got, I don't know, CC, or what, Bollinger Bands actually, and RSI was the most popular uh, indicator pair for leading and lagging, right? But actually, let's take a look at this. I'm going to show you a few, right, combinations, all right? So actually kind of staying here, right? So we got, let's go. So the most popular is Bollinger Bands. There it is. And RSI. This is actually probably one of the most popular indicator combination. But I don't know, not my favorite, but at the same time, it's pretty good. Now, here's the thing: in Bollinger Bands, the bands themselves, right? We've got the top and the bottom line. These are the Bollinger Bands. The one in the middle, it's a moving average, which is also a lagging indicator. But essentially what it says is that anytime the asset breaches the Bollinger Band, it kind of tells you that it's outside of its comfort zone. It's outside of its price range, right? So it wants to come back in. And well, as I mentioned, I'm not like the biggest fan of this, but let's kind of see if we can spot some really good ones, some good possibilities. All right, so we got, there we go. We got like an upward movement trend. We have the asset that kind of keeps hopping, slightly outside, but we're looking at the point where it's overbought and it breaches the Bollinger Bands, right? So kind of like at this point right here, right, we see that it went outside of the Bollinger Band. It closed out there. On the next one, it kind of went back in, right? There was a bit of a retracement, but as you can see, it closed higher still. So again, it breaches the Bollinger Bands. That means that it kind of wants to go back in, right? So we do see lots of wicks, right? So it came out, and you're like, oh, if you opened a position for a retracement here, well, it closed lower, you would have been in the money. So it went outside, you opened the position here, it certainly closed lower. Right, so it went up to here, it went outside of the Bollinger Bands, but you can see that it's not really overbought or oversold, it's kind of in the middle. It did retrace, right? It did retrace and closed a little bit low, higher. So in this case, you would have been in the money. But this is something that, would be your call, your judgment call to see if, what kind of statistics this gives you. So I'm not a big fan, but it is, as mentioned, this most popular indicator pair for leading and lagging. But you do need to wait until the asset is, on the overbought, where it touches or breaches, and then it kind of also breaches the Bollinger Band. That means that you open a position for a retracement, and it wants to go back in. So let's see if we can spot like another one. Let's say like, once again, it didn't really touch the 20, but there we go. You see that it breached out, way out. They opened the position here. It certainly would have, even with a timer, right, for 60 seconds, it carried over and actually closed, much higher. Here we got one for RSI showing that it's, close to level overbought. But, then we have these kind of moments. In this case, it's overbought, and any time the asset breaches the Bollinger Bands, right, we do expect it to go back, right? So it breached, on the next one it went out. Here it kind of touched, I don't know, I would have said that it closed exactly on the level. It breached, it, went back in. It breached, well, it closed higher once again. So this is something but let's see if we can spot, maybe a few different ones. Let's see. CCI and shaft or demarker, right? These are like one of my favorites because CCI actually says when the inertia of the momentum might actually be very strong, right? So anytime it touches the positive 100, right, in this case, right, well, it kind of usually says that, hey, next couple of candles should be green. If it touches the negative 100, it kind of says the opposite. Hey, next couple of candles should be red. So it actually shows you when the momentum has really good inertia, that it should be going upwards. Now, demarker and shaft, they kind of do the same thing. They tell you when the trend is reversing, right? It's a leading indicator that here it's a buy signal, right? Because it says that, hey, this is a sell signal, this is a buy signal, because it touches from the outside, right? The line touches from the outside, it touches this, means that the negative trend, negative movement up to here was, kind of over, but now it started to go upwards, right? And while it's above, it just continues to tell you that it is bullish dominant, right? It's bullish dominant. Now, when it reverses, right, when it rounds out, once again, right, we see exactly the same thing. DeMarker does exactly the same thing, though the formula to calculate the quotes is a little bit different. And actually, I prefer shaft trend cycle versus demarker, but once again, you're not me. I don't ask you to follow and do exactly what I say or, exactly what I do, because that is different. As I mentioned, based on psychological demands, based on your finances, your goals, all of this has a massive impact on how you're going to be trading, right? But the idea is the same, that here it went under and touched here, it says buy, right? It went under and here, I think it kind of said touch here, but it would have been a false signal. Here it once again touched, it kind of dipped back in and touched again. I don't know. This is something, once again, for you guys to be able to test and determine. Here it's a buy signal. We can see that shaft did the same thing. So here it's a sell. You can see a couple of red candles. Here it's a buy. You can see a couple of green candles. This is not really a signal because it didn't come from the top. But, once again, this is something that you could keep an eye out. And, statistically speaking, here it's a sell signal. As you can see, there's a couple of, red candles. Here it's a buy signal. Well, depends on how, what kind of expiration, but essentially you do see that it is going upwards, right? Here it was going down. Actually, I would have probably opened the position here for a sell. I would have lost, but, second time, right, second step martingale, for example, if I followed only shaft, which is not really advisable, as I mentioned, because leading indicators tells you where the market might be going, but lagging indicators, they do very good during volatile market conditions versus flat, and market can change between them very fast. So here, sell signal, as you can see, I would have been in the money. Here it's a buy signal, I would have been in the money. Here it's a sell signal, and I would have been in the money. So statistically speaking, you can actually just go back in history and see, based on the signals, which one of these indicators is more suited for you, which one of these leading indicators might tell you when the trend is over, which is actually also very important. For example, if we got shaft and we turn on alligator, there it is, right? So, once it starts to, go up higher here, you're opening a position, and you understand that alligator is also kind of showing you, right, that there was a crossing here at this candle right there of the green and red line. Green is on top. It kind of means the trend is picking up momentum. And if you open the position for a flag, right, for a specific expiration, for example, end of minute, right? So here you would have, had 1, 2, 3, 4, 5, 6, 7, 8 successful trades in a row, right? But at some point, right, this one would have been false. You would have lost money here if you would have bought. But here again, second step martingale, right, with proper money management, you don't need ideal statistic. And you would have made money back, which you've lost and still been a profit, and that would have been essentially 10th position, 11th, 12th. But now you see that the asset is sawing a particular level, right? We could have looked at the indicators like a lagging indicator, like ATR, and it shows you that, hey, at this moment, right, the volatility started to drop. All right, there we go. It started to go, and then it started to go kind of reverse. And again, right, we see that the trend is reversing. There we go. At this point, Schaff is saying, hey, all of this big upward movement has come to an end, and here it already calculated that there is a reversal, right? We can actually see this with a trend line, a resistance level. There it is, right? So that's it. But while it's below this line, it should continue to go below. But depending what kind of signals you trade, if you get signals like 3 every hour, right, you need to understand that, man, you're going to need to sit in front of a computer for a while to get some results. Because if you got 2 out of 3, but you open for 1% of your total balance into each position, it just means that you're going to be in front of a computer for a long time, putting some money together. Versus there is an expression, trend is your friend, right? So you go with the trend and you essentially understand that, hey, I should keep an eye out on the trend to see when it's over, right? Because when one trend is over, right? Because let's see, I can show you this way. Also, all right, we got a support level. Probably not the best one, but let's just say something like this. You got a support level. While it's above this line, it should continue to go. We went once, twice, 3, 4, but on the 5th time, it kind of broke through, went under, and there it is. There was another trend. There was significantly more red candles here than green ones. All right, then the trend increased its momentum, its decline, and we also understand that once it broke through, chances are it would have continued to break through, and we have an establishment of a new trend. There it is, like this. Anyways, I will go into greater detail with regards to support and resistance levels in next stream, so do not miss it. There are certain patterns that we're able to determine, and anyways, this is not magic. We are able to understand what we're looking for, what we're looking at, what kind of points of interest there are with regards to what we've just done with all of these support and resistance levels, but it's always a good idea to confirm it with indicators, right? So we understand that here it started to go down. We see that the alligator mouth was closed for this time. It opened. There it is. It was a nice, great drop. And at some point, there it is. It stopped, right? It stopped, falling. It started to retrace. And we see, hey, is there going to be a minor retracement and a continuation? We'll look at other indicators. Hey, first of all, that's a breakout strategy. That's already giving you a clue. Second, there is a reversal at this point right here. We got a signal from shaft saying that's it. This negative movement is over. And, this is where you should start buying. In the next couple of candles, we got confirmation from the alligator, right? That's closing its mouth. It's, retracing, or it's crossed over here, the red and green. And it shows you that, yes, there is a bullish potential. And at this point, it already touched once, twice, 3, 4 times, right? Once again, while bouncing away, that's also a signal. So there's lots of signals. This isn't something that, oh goodness, I wouldn't even know how to say this. This isn't something that's very list specific. This is kind of like, I don't know, it's kind of like an art. Somebody can go up to a person and start talking to them, so easily about just, pick up a conversation. It's not something you can teach it to a degree, but if somebody's shy, it might take them a while to kind of get a hang of this. So, why did I say that? Because there isn't such a thing as like 2, 3 indicators, and that's all you'll need. It's a little bit of everything. It's kind of like building a relationship. It's courting the market, while understanding that you are not the one that ever to tell the market what to do. All right, so it is an important thing to analyze it. I really don't like the word strategy. Strategy implies very repetitive action. But I think the market is never really as repetitive to 100%, right? Or to a great degree where, one approach is able to be applied all the time, always. So that's why I like the word analysis, right? You analyze the market, you understand essentially where is the ideal point of entry. You see with other leading and lagging indicators, right? Both, you need both. It's not really that one is good, the other one is bad. So I'm mixing my signals here, all right? But it is something that is necessary to kind of take in the whole picture. Right, to take a step back and to see everything, right? We're actually going to talk on the next streams, next videos. I'm going to create, more content based on the demands, and one of the things is that to be able to see, to understand the multi-graphic, right? We'll be able to actually look at 2 graphs at the same time. euro dollar OTC, but maybe here instead of 1 minute, we got 3 minute graphs. So if there is a trend reversal, we see it a little bit more, sooner. We see it quicker. Right, so here we got the 1, 2, kind of 3 point contact. We got 1, 2, 3 point contact. It's the same. But where here we're looking at 1 minute, here we're looking at 3 minutes. We get you to see the bigger picture of where the levels of interest are, where there might be points of reversals, and we also see confirmations from indicators, both leading if the market is going flat and lagging if the market is very volatile when there is an ideal entry point. All right, so I've been yammering for like 40 minutes. I see that, maybe, Henry and Donald kind of said hello. But I do encourage you guys, if you ever come across this, smash that button. I will be talking about very interesting things once again. Not something that you'll ever need to trust me. This is the this is kind of cool thing. Why I'm very excited about this. I want to talk to all of you about this. But the idea is that I'm going to show you, for example, this week, right? Tomorrow, I am going to do another live stream, but tomorrow we have, tomorrow's the 20th, we have Canadian CPI, Consumer Price Index. Uh, that particular macro, it's actually a leading indicator of inflation, which is deciding the factor, or which is a decisive factor in central bank rate change, right? So actually, I don't know, hold on a second, let me switch over, let me just find my mouse. There we go. All right, so if we go to any calendar, right, Forex Factory is one of them. Let me kind of walk you through this week. Oh, sorry, there we go. This week, and we apply the settings. So today, on the 19th, that's why we're talking about the importance of leading and lagging indicators, the volatile market conditions versus not. So that's why we're just kind of, I have this chats open. I'm hoping that somebody will write a question so we can maybe start a discussion where I can clarify this instead of me monologuing. But anyways, look, tomorrow, right, and this is very important. Let me actually refresh the page so it shows the right time. All right, so there we go. And it's going to be Sunday through Saturday. And yeah, so 19th, there's nothing, right? But tomorrow, and this is where we're going to have the stream, Canadian CPI. This is very cool because Consumer Price Index, I think I might have mentioned already. Inflation, yeah, leading important inflation-related release. So if inflation rises, the central bank will want to raise the interest rates to curb spending inside the country, but it also has very impactful things from international investing, from actual forex. But I'll go into greater detail about this maybe a little bit, no, actually tomorrow. So I do encourage you to tune in. I can tell you exactly that at 3:30 GMT plus 3 time, Canadian government will release this statistic, and there will be a reaction right down to this second. You and I, if you guys join, will do a countdown at 5, 4, 3, 2, 1, and as soon as we hit 1, there's going to be an impulse. It's going to be a much bigger candle than the ones before, and I can tell you that after their big spike, there tends to be a what? Retracement. And once again, I'm Morpheus, but I'm not, some clairvoyant, but just telling you that I'll explain to you based on logic, facts, math, statistics, why things happen. You will understand that if you want to make money, you are able to do that without relying on luck. All right. All right. So there we go. So this is where, very quickly, let's kind of go over it. So Tuesday, right, tomorrow, we're going to talk about CPI. On Wednesday, much earlier, right? Actually, I don't know if some of you guys will be able to touch base with me, because in America at that point it's going to be wicked, wicked early or late, however you look at it. But hopefully our audience maybe will be able to appreciate it anyway. Videos are going to be posted obviously afterwards, and you guys will be able to take a look at them anytime you want. Thursday, we got a super, super awesome day on Thursday. There's flash manufacturing services and manufacturing and services PMIs. All right, so this is actually when we're gonna do it. We're gonna do it around. We're gonna start our stream at like 10 o'clock. GMT plus 3 time, and we're gonna get hit up two of them, right? We're gonna see a reaction for French flash manufacturing services PMI and German. Now France, well, actually I really don't really know anymore who is ranked top. But it used to be before the sanctions with Russia and natural gas. It's kind of like a geopolitical thing that we can also discuss. We can also understand. You know what I'm saying? That Benz, I think that Mercedes-Benz left Germany um, because it's not profitable to do business there anymore because it is a very industrial country. But with sanctions on Russia, they kind of lost the access to cheap natural gas to run their factories and things like that. So when things are becoming more strenuous in one place, usually companies take their business and they open a factory somewhere else where it will be cost, outsourcing. So we're just going to cost a little bit less to make it. Apple, I think that most of the Apple products are, built in China. Why not in America? It's an American company. Well, because in America it's much more expensive. So this is also something that you and I are going to go into details. This is part of fundamental analysis. The real reason why the market is going up or down is based on these macro statistics. And as I mentioned on Thursday, there's a whole bunch of them. We're going to cover these two, but you're going to be able to do this yourself at 11:30 and take a look at the GBP. Yes, it will be reacting. And later, well, there will be unemployment claims at 3:30, but this is a weekly statistic, so it's not something that's going to affect the market very much, unless it's a shocking statistic, right? So if it comes out to be like 150, yeah, there might actually be a reaction to this. And yeah, 4:45, GMT plus 3 time, as I mentioned, is going to be manufacturing services PMIs for United States. And on Friday, we're going to continue today's topic. We're going to continue today's topic about leading and lagging indicators. We're going to see a little bit more of examples, all right, and maybe indicator pairs. If you guys have any kind of questions or maybe desire to cover a specific indicator for me to, talk about, just tune in, write in live chat, say, hey, Alex, what's going on with, this or that indicator, how you get signals, is it leading, is it lagging? But as I mentioned, the leading indicator is the one that's under the charts. It tells you where the market might be going. It does good signals when the market conditions are kind of flat. But then we also got the lagging indicators. That's the indicator that is superimposed on the chart itself. All right. Let's actually kind of go back and again. So let's go to one chart so that we see everything on big screen. There we go. All right. Let's remove the unnecessary things. Right. So lagging indicator. It's the one that's on the chart, right? So anything that's right here on the computer that you put in, it's on the chart. That's something that is a lagging indicator. And it does very good during volatile market movements. Whoosh. When the indicator pops under the chart with a range, right? This is something that is a leading indicator. There we go. Accelerator, Arun, bears and bull power, demarker, MACD, OSMA, right? All of these are leading indicators, and they tell you where the market might be going in the near future. All right, there we go. So, yeah, Donald, my man, Donald is in here in the house, still paying attention with us. Donald, I definitely appreciate it. Thank you, buddy, for as I mentioned, for sharing some of your thoughts, ideas. I do think that the week is going to be very interesting. I do encourage all of our friends to kind of hop in here to see, to share, to ask whatever it is that might be on your mind. All right, my friends, I think that, well, since there's no questions, I think we're going to cut it short, just a little bit shorter. Oh, there we go. What is the difference between CPI and PMI? Oh, damn, my man. All right, wait a second. Let me actually kind of walk you through this. Donald, thank you for a very, very interesting question. Now, PMI, right? So actually, the CPI, it's a consumer price index. And actually, you know what? What you can do is you can on any in the forex calendar, you are able to get a little bit extra clarification to any particular event. So we got okay, CPI, right? So what is it, right? It's acronym expanded. It's consumer price index, right? CPI. So it's where it's come from. It comes from Statistics Canada, latest release. There we go. What does it measure? Right? Change in price of goods and services. Right? So if you buy something, buy, the value of that thing is going to rise. The price of that thing is going to rise because demand is rising, supply is lowering, and the value or the price goes up, right? So that's essentially, you can kind of get a little bit more, on your own terms at your own speed. Read what is a trimmed CPI, by the way. Okay, so we can why traders care, right? So it's an inflation, most important currency valuation, because rising prices leads to central banks to raise interest rates out of respect for their inflation containment mandate. All right, so derived via price of goods and services, a sample. So, anyways, this is where you can get a little bit of information, but it's also has sometimes different names. Core CPI versus, trimmed CPI, median CPI. So there is a bit of a difference between them, but they're all coming out at the same time anyway. So these statistics, the actual number versus the forecast is the ones to keep an eye out. So if it's higher, it's good. If it's lower, it's bad. Right? But we also kind of want to keep an eye out on the previous month. PMI, on the other hand, right? So when we open, there we go. We can take a look. It's Purchasing Managers Index. All right. So businesses react quickly to the supply and demand principles, right? And actually, I think that's where it's businesses react quickly to market conditions, supply and demand principles. If you have a factory that produces refrigerators, and the demand from you were ordered to produce 50 refrigerators, you're not going to buy like 100, million tons of steel to create, the boxes for refrigerators because there's no demand, right? So the, purchasing managers index, right? The purchasing managers for their factories, for their goods, the services, they react to the demand, and this is the statistic that is also something that shows this. So, anyways, this is the difference, Donald. I don't know if I've answered. All right, appreciate it. Uh, Appreciate your feedback, buddy. Right, so take a look. Tune in with us next. Tune in with us tomorrow. I'm not gonna disappoint. You're certainly gonna see the market. We're gonna do the countdown. You're gonna see the market react. I'm telling you about this ahead of time. It's gonna be in the real market, not in OTC. This is live. You are able to click on the link that's below. That's in the profile of this channel or in Telegram. You can ask me for it. I can send you the link to this wonderful platform, Pocket Option. We can even discuss the point where I will insure your trading. Right? I put my money where my mouth is. I will actually insure your trading for a particular percentage if you guys want, so we can talk about it. But through the link, you are able to go to this wonderful platform and live yourself see the reaction to CPI. And Canada, it's neighboring partner. Well, it's neighboring with United States. It's the biggest economy in the world. United States. 70% of all of the goods that are exported from Canada go to United States. So that's why tomorrow there will be a reaction. Right? It might not be, staggering 100 pip candle, though it could be. Though statistically speaking, historically, statistically speaking, it's unlikely, but it should be noticeable. So, my dear friends, Donald, thank you for hanging out with us. Genry, appreciate your time. Appreciate you saying hello. Hopefully, I will see you guys tomorrow or whenever you have some free time. The schedule for the week is posted in our Telegram channel where you once again can ask any kind of questions, get personal info, personal clarifications, and there you go, guys. So it's in your hands. If you guys want to make money, let's do it. Let's do it. Let me show you how. All right. See you guys tomorrow.